Welcome to The Explainer, everyone. I am absolutely thrilled to have you here today. Seriously, go ahead and put on your analyst hats right now, because we are stepping directly into the shoes of a sell-side equity analyst. We've got a massive and, quite frankly, fascinating disconnect in the market to unpack today. We're looking at a company called Remitly, and right now, there is just a yawning chasm between the price the market is assigning to Remitly's stock and the true intrinsic value of its underlying business. Now, as analysts, we don't really care about market noise, right? We care about the numbers, the fundamentals, and the rigorous models. So let's get right to work and see what the data is actually telling us.
Okay, let's dive right into this. Here's how we're going to structure our fundamental analysis today. We'll start by looking at the valuation disconnect, analyze the explosive growth and fundamentals, run a relative valuation, calculate the absolute valuation using a strict DCF model, assess the risk and capital structure, and then finally, we'll nail down our final intrinsic value assessment.
Moving to Section 1, the Remitly Valuation Disconnect. Let's dig into this financial mystery.
If you pull up Remitly on your terminal today, you're going to see it currently trades at a last close price of $22.79. At this share price, the market is valuing the entire enterprise at a market cap of about $4.645 billion. But look, $22.79 is literally just a sticker price. It tells you what it costs to buy a single share today, sure, but it tells you absolutely nothing about what that share is actually worth.
Now, what's really interesting about this next piece is the massive juxtaposition we see when we actually run the fundamental data. The market price sits at that $22.79. But our absolute valuation, which we derive from a rigorous discounted cash flow model, pins the fair value way up at $56.84. Guys, we are looking at a staggering 59.90% margin of safety here. In the valuation world, a margin of safety this wide usually implies one of two things. Either the market is pricing in some apocalyptic risk that just doesn't exist in the filings, or it has completely fallen asleep at the wheel regarding Remitly's cash-generating power.
Section 2, Explosive Growth and Fundamentals. Let's look at the actual business performance.
At the operational level, the reality becomes crystal clear. Just look at how this brilliantly illustrates reliable, long-term top-line revenue growth across the 5-year, 3-year, and trailing 12-month periods. It's hovering consistently right around that 30 to 40% mark. But the bottom line? That is where the magic really happens. Net income has absolutely exploded in the trailing 12 months by nearly 284%. So this isn't just a company growing its sales. It's a company that has clearly hit an inflection point where those revenues are violently translating into actual hard profit.
And we can see that operating leverage playing out in these key metrics. Earnings per share growth in the last 12 months is up over 764%. Free cash flow is growing at over 60%. And this is all built on a massive foundation of $1.635 billion in trailing 12-month revenue. But you know what's fascinating? If you look at the 5-year stock price history, it's actually negative, a negative 13.3% CAGR. So the stock price has been incredibly bumpy, even declining over a longer horizon, while the underlying cash-generating power of the business has just gone into overdrive. That divergence right there is the exact birthplace of our valuation opportunity.
On to Section 3, Relative Valuation and Multiples. Now that we know the underlying business is booming, let's evaluate how Remitly is actually priced against its own historical averages. Since external peer comparables are notably absent from the provided source filings, we're going to benchmark Remitly against its own baseline to gauge relative cheapness or expense. Just as a quick refresher, relative valuation is simply evaluating a company's worth by comparing its pricing multiples, things like price to earnings or price to sales, to similar companies, or in this specific case, its historical self. We're doing this to contextualize that surface-level $22.79 sticker price we saw earlier.
When we look at the current multiples, a skeptic might immediately point right to the PE ratio. At 73.52, the current price-to-earnings ratio definitely looks highly expensive, especially compared to his trailing 12-month average of just 15.62. Even price-to-sales and price-to-free cash flow are currently trading above their recent averages. If you stopped your analysis right here, you'd probably conclude the stock is wildly overvalued. But remember what we just saw in the fundamentals. EPS just grew by over 764%. These pricing multiples are just a snapshot in time, and right now they are trailing the recent explosive fundamental growth. So the absolutely crucial point here is that you cannot look at a PE ratio in a vacuum. You have to factor in growth. When we do that, we look at the PEG ratio, the price-earnings-to-growth ratio. As you know, a PEG ratio under 1.0 is generally considered undervalued. Well, Remitly's PEG ratio is an astonishingly low 0.28. This signals deep undervaluation. It totally bridges the gap between those optically high traditional multiples and the firm's true intrinsic value. The market is basically pricing the PE without fully digesting the G, the massive growth.
Which brings us to Section 4, Absolute Valuation, the DCF, the most rigorous part of our fundamental deep dive.
Before we reveal the output, let's explicitly outline our methodological choices as analysts, because a robust valuation only uses models that actually fit the data. First up, the dividend discount model, or DDM. We're skipping this entirely, because Remitly has a 0% dividend CAGR. They don't pay one, making DDM totally useless here. Second, the sum of the parts, or SOTP valuation. We're skipping this one too due to data constraints. There's just no specific segment data reported in the filings to break apart. Therefore, we are placing our full, unadulterated analytical weight on the discounted cash flow model as our primary valuation driver.
So let's strip away all the market sentiment. Strip away the messy historical stock charts. Just ask yourself, what is Remitly actually worth based purely on its unadulterated, fundamental cash-producing power? The answer begins with this specific number, $282.9 million. That is the trailing 12-month free cash flow. That is the actual, tangible cash the business generated after accounting for all operating expenses and capital expenditures. It is quite literally the lifeblood of our valuation model. Let's move to and see how this actually builds out our intrinsic value model. Step 1 is our baseline, that $282.9 million in current free cash flow. Step 2 is growth. We project future cash flows outward, heavily informed by that massive 60% recent free cash flow growth rate we saw earlier, forecasting both an explicit period and a terminal value. Step 3 is the discount. We apply a discount rate, incorporating the firm's cost of capital, to bring all those future projected cash flows all the way back to today's present value. And finally, step 4 is the output. We sum it all up, divide by the shares outstanding, and the math dictates a definitive intrinsic value of $56.84 per share. It's not a guess, it's a mathematical certainty based strictly on the cash flow inputs provided right in the filings.
Section 5, Risk and Capital Structure. Let's make sure our assumptions are safe.
Look, a good analyst always double-checks their work, right? A DCF model is literally only as good as the balance sheet supporting it. If a company is drowning in debt, those projected future cash flows might never actually materialize. So, is the balance sheet here safe enough to support our assumptions? The answer is a resounding yes. Look at the chart. The current ratio sits at 3.30, meaning the company has more than 3 times the liquid assets required to cover its short-term liabilities. That is just phenomenal short-term liquidity. But more importantly, the debt-to-equity ratio is an incredibly low 0.18. The company is essentially unlevered. Bankruptcy or debt distress risk here is practically non-existent. The capital structure is pristine.
And we can see management is actively translating that safe capital structure into highly efficient, profitable operations. Gross profit margins are sitting incredibly strong at nearly 66%. Return on invested capital, or ROIC, has swung positive to 9.52%, which, by the way, is a 138% improvement from its 3-year average. And perhaps most attractively for a fundamental value investor, the free cash flow yield is a really robust 6.09%. You're getting excellent, reliable cash generation for the current price you're paying.
Section 6, Final Intrinsic Value Assessment. Let's synthesize our data into a final analyst thesis.
When we look at the absolute totality of the filings, this is the inescapable conclusion. Explosive cash flow growth and a pristine balance sheet dictate a $56.84 intrinsic value, offering investors a rare 60% margin of safety. The fundamental analysis overwhelmingly, undeniably points to Remitly being deeply undervalued today. Those high surface-level historical multiples we saw are entirely offset by the massive hypergrowth we identified in the PEG ratio and its incredible free cash flow generation.
Which leaves us with this somewhat provocative final thought. The rigorous DCF math, based purely on the company's own reported cash generation and its totally unlevered balance sheet, says the stock is worth $56.84. But the broader market, perhaps distracted by historical price action or just completely misunderstanding the recent growth inflection, is pricing it at $22.79. So, what does this all mean? Who is right? The market's current sticker price or the fundamental models? Well, as a fundamental analyst, I know exactly where I place my trust. Thank you so much for joining me to unpack this fascinating valuation explainer, and remember, always keep trusting the data.